Diversification. Los v. Define diversification and discuss the rationale for diversifying. Diversification is a corporate-level strategy in which a firm expands its operations into new industries, markets, or product lines beyond its current core business. Rather than concentrating on a single line of business, diversified firms manage a portfolio of businesses. Diversification decisions are based on evaluating growth opportunities, risk exposure, and the potential to create value across multiple operations. The rationale for diversifying includes risk reduction through revenue stabilization. When businesses operate in different industries or life cycle stages, poor performance in one segment may be offset by stronger performance in another. This can reduce earnings volatility and improve financial resilience. Diversification may also provide growth opportunities and value creation potential when the firm can exploit synergies, leverage capabilities, or enter attractive industries. However, diversification must create more value than operating as separate entities to justify added complexity. Los W. Distinguish between concentric, related, diversification and conglomerate, unrelated, diversification. Concentric, related, diversification occurs when a firm expands into industries that share strategic similarities with its existing business, such as common technologies, markets, or value chain activities. The goal is to exploit operational synergies, transfer competencies, and share resources. Related diversification often enhances competitive advantage through economies of scope. Conglomerate, unrelated, diversification involves entering industries that have no direct connection to the firm's existing operations. The primary objective is typically financial diversification rather than operational synergy. Businesses operate independently within a broader corporate portfolio. The key distinction lies in the degree of strategic fit. Related diversification emphasizes synergy and shared capabilities, while unrelated diversification focuses on risk spreading and capital allocation efficiency rather than operational integration. Los X. Identify and explain how a diversified company can increase profitability. A diversified company can increase profitability by transferring and leveraging distinctive competencies across business units. For example, technological expertise, marketing capabilities, or process innovations developed in one division can be applied to others, reducing costs or enhancing differentiation. Profitability may also increase through sharing resources and extending brands. Shared distribution networks, procurement systems, or administrative functions create economies of scope. Strong brand equity can be extended to new product lines, reducing marketing costs and accelerating customer acceptance. Additional value arises from bundling products and leveraging general managerial competencies. Offering complementary products as integrated solutions enhances customer value and switching costs. Skilled corporate management can allocate capital efficiently, restructure underperforming units, and improve overall portfolio performance, thereby enhancing long-term returns. Los Y. Identify and explain the possible disadvantages of diversification. Diversification may fail due to changes in industry dynamics. Attractive industries can become less profitable because of increased competition, regulatory shifts, or technological disruption. If entry assumptions prove inaccurate, the expected synergies and returns may not materialize, reducing shareholder value. Increased organizational complexity and bureaucracy is another major disadvantage. Managing multiple businesses requires more layers of administration, coordination systems, and reporting structures. This can slow decision-making and dilute managerial focus, weakening responsiveness to market changes. Diversified firms often face integration and coordination challenges. Cultural differences, incompatible systems, and unclear strategic fit may hinder synergy realization. Additionally, management may resist divesting failing units due to emotional attachment or sunk costs, prolonging poor performance. Los Z. Evaluate a scenario and recommend a diversification strategy. Scenario evaluation begins with assessing industry attractiveness, strategic fit, and financial capacity. The firm should only diversify into industries where it can create value beyond what independent ownership would achieve. Analysis should determine whether related diversification can generate operational synergies or whether unrelated diversification primarily offers financial benefits. The recommendation must consider core competencies and transferable capabilities. If distinctive competencies can be leveraged across businesses, related diversification may enhance competitive advantage. Without synergy potential, Diversification may dilute strategic focus and increase risk. A strong recommendation clearly explains how diversification improves long-term profitability, reduces risk appropriately, and aligns with corporate objectives. It should also address integration feasibility and exit strategies if expected benefits fail to materialize. LOS AA define portfolio analysis and identify its advantages and limitations. Portfolio analysis is a corporate-level tool used to evaluate and manage a firm's collection of business units. It assesses each unit's market attractiveness and competitive position to guide capital allocation and strategic priorities. The goal is to optimize the overall portfolio for long-term value creation. Advantages include structured decision-making, improved resource allocation, and identification of underperforming or high-potential units. Portfolio analysis helps management balance growth, risk, and cash flow across the organization. Limitations include oversimplification, reliance on quantitative metrics that may ignore qualitative factors, and potential misclassification of business units. Market share and growth rates alone may not fully capture strategic value or future potential. LOS BB. Apply the BCG Growth Share Matrix and G. McKinsey Matrix. The BCG Growth Share Matrix classifies business units into stars, cash cows, question marks, and dogs based on market growth rate and relative market share. Relative market share is calculated as units market share divided by market share of largest competitor. A ratio greater than 1 indicates market leadership. The matrix guides resource allocation decisions such as invest, hold, harvest, or divest. The GE McKinsey Matrix, GE Business Screen, evaluates business units based on industry attractiveness and competitive strength using multiple weighted criteria. It provides a more nuanced assessment than BCG by incorporating qualitative and quantitative factors. Both tools support strategic allocation decisions, but they must be applied with judgment. They offer guidance rather than definitive prescriptions and should be integrated with broader strategic analysis. Mergers and acquisitions. LOS CC compare internal investment, organic growth, merger, and acquisition, identify benefits and challenges of each. Internal investment, organic growth, involves building a new business from within the organization using its own resources. Benefits include full managerial control, gradual capability development, cultural consistency, and lower integration risk. It allows the firm to grow at a manageable pace aligned with strategic objectives. However, organic growth is typically slower than mergers or acquisitions, may require substantial upfront investment, and involves higher market entry uncertainty without immediate access to established customers or distribution networks. Merger combines two firms into a new entity, typically with shared ownership and collaborative integration. Benefits include resource pooling, shared risk, expanded capabilities, and potential synergy realization. Mergers may foster cooperative cultures when structured properly. Challenges include complex governance arrangements, integration difficulties, cultural clashes, and slower decision-making due to shared control structures. An acquisition occurs when one firm purchases another, gaining control over assets and operations. Benefits include rapid market entry, immediate access to customers and revenue streams, and potential cost or revenue synergies. Acquisitions provide clear authority and centralized decision-making. However, they often involve high acquisition premiums, integration risk, cultural misalignment, and potential overestimation of synergy benefits, which can erode shareholder value. LOS DD evaluate a scenario and recommend whether to enter through merger or acquisition based on industry context and NPV. Scenario evaluation begins with assessing strategic fit, industry conditions, and competitive dynamics. In highly competitive or rapidly consolidating industries, acquisitions may provide speed and decisive control. In collaborative or complementary industry contexts, mergers may better align long-term objectives and share risks. The recommendation must consider whether integration complexity is manageable and whether synergies are realistic. Financial analysis is critical, particularly the net present value, NPV, of forecasted cash flows. The firm should pursue the option that generates positive NPV and exceeds its cost of capital. Expected synergies, integration costs, and acquisition premiums must be incorporated into projected cash flows to ensure realistic valuation. Strong recommendation integrates both strategic and financial considerations. If acquisition provides faster control and superior NPV despite higher risk, it may be preferred. If shared governance enhances value and reduces capital burden, a merger may be more appropriate. The final decision must align with long-term value creation.